with our first webinar as a result of a lot of the questions that many of our clients and contacts were asking us right in the middle. It was March 13th, so it was right in the middle of this disruption, of course, we had and continue to face worldwide. So we thought it would be a good idea to address a lot of these questions that a lot of folks had in their minds. Second webinar we had was an introduction to the team. Some of the team members, the key team members that many of our clients perhaps had not met, at least face-to-face, but are very key members of the organization, both with Boston Retirement Advisors and Beck Bode. That included Angel Williams, that included our two co-directors of financial planning, Misty Lynch and Meg Curry, as well as Mike Kelly, our head analyst on the team and very important part of our investment committee. Third webinar we had the following week was a live Q&A, an opportunity for all attendees to type in either questions live. We had also sent an email out, numerous communications, and collected a number of questions beforehand that were on people's minds to address live on the webinar. And then last week, we reintroduced Misty Lynch, co-director of financial planning, where she covered many, many great topics. We get a lot of great feedback from the webinar last week with respect to a lot of different types of scenarios that people either are or could be focusing on during this time that we're going through here. So before I hand it over to Jim, in terms of today's speaker, a few things we have coming in the future. We are continuing to, aside of today, which is centered around tax and tax planning and some of the tax changes that have come up recently with different acts. We have Social Security and Medicare experts coming on in the near future. We have college planning specialists that will be speaking, which is certainly something that we're getting a lot of questions on more recently with, will colleges delay opening perhaps in the fall? Will a lot more things be done via mediums like this, like webinar and Zoom and such? And how would that affect college loans and things of that nature? So very relevant topics. A lot of questions that we're getting quite a few questions. Health, fitness, and nutrition experts. How many of us have perhaps not focused so much on the diet over the past month or two? And perhaps, we can't get out to that. Jim can't get to his early morning yoga class out every day, perhaps. But all kidding aside, we are in an environment where it has disrupted perhaps what we're eating, how we are exercising our activity, and really helpful to have some experts from the health and nutrition industry to come on and provide some information and some thoughts on what are some of the things that we could be focusing on as we move through this and move back to a period of normalcy. So a lot of good content coming in the very near future with these webinars, and we're very excited about it. And with that, I'm going to hand it over to Jim to make some introductions, and great to have everybody aboard today.
Perfect. Thanks, Ben. Today, obviously, we're going to hear from Rick Dlugasch. Just a little quick background for those of you who don't know Rick. He is a personal friend of ours. He is a CPA and managing partner of Waldron H. He works with mostly individuals and businesses of various sizes. Waldron H is actually one of the oldest, and I'm sure he'll argue the oldest CPA firm in the country. And personally and professionally, Beck Bode, as well as many of our clients, have been working with Rick and the firm for over the past 10 years. This past week, as Ben mentioned, we were fielding a lot of questions, and really have been since the beginning of this year, about recent tax laws that have changed, really starting back in January, that many of you weren't aware of. And then obviously more recently with the CARES Act. And Rick's going to go into many of those items here over the next 15 or 20 minutes. But as usual, if you have specific questions You can type them in at the bottom, remembering that on an individual basis, tax planning is very personalized, and sometimes that may receive or may have to have a one-on-one phone call just to make sure we're addressing those appropriately. But feel free to type them in at the bottom, and we'll do our best to get to them. But let's jump right in. Rick, welcome. Obviously, we appreciate the time and you be willing to do this for us. If he's there.
Can you hear me?
There he is. Yeah, we've got you now, Rick.
All right, can you see me?
No.
No, huh?
Want me to make you seen?
Yeah, if you could.
I don't know if I can.
Well, if not, we can just.
You're good.
I'm good? All right. All right, thank you. Over the past, month basically, since the middle of March, there's been so much focus, particularly at my office, on the various, loan programs out there, the payroll protection, the PPP program. I'm spending pretty much all day, every day on the phone with clients working through that. And although we gave a webinar a month ago and focused on a few of the, tax, and there were some major tax changes that were part of that, the $2.2 billion stimulus package. Not a lot, over the past month, not a lot of questions came up for that, but now is the time. I think we got to start focusing on some of the tax opportunities that are available. And as part of the Stimulus Act, the idea was to create liquidity. So they came out with, probably a half dozen major tax changes to provide liquidity. And I'm really just want to touch on, a few of these, and then maybe we could have some questions. All right, in the area of, retirement plan, one of the things they did to create liquidity, or hopefully create liquidity, is they allow people to take up to $100,000 out of your retirement plan and to avoid the 10% early distribution penalty that normally would be there. And not only do you avoid the penalty, but you actually have 3 years to either pick up the income of the 100 grand over the 3 years, or for that matter, to pay it back as effectively like a rollover and not pay the tax on it. So that's an opportunity to get some liquidity. Now, in theory, it has to be, virus related, coronavirus related, but it's very broad. It's somebody, in your household that came down with it. It's your job, your income is down. You're obviously got a furlough, or the IRS agrees that it's somehow related. And I think in this world today, everything is related. So I think that's a big opportunity that's out there. You can also, used to be you can borrow up to $50,000. They upped that limit to $100,000 now, and I think you have more flexibility on the repayment terms. But all of that has to be, the plans have to be modified to allow for it. But the IRS is giving the plan administrators the flexibility to amend the plans to allow for these type of loans. And another big one, which is sort of overlooked, is they temporarily delayed the required minimum distributions that everybody had to take out in 2020. Usually by April, you have to take it out. You can waive that for 2020. So you don't have to take it out. And if you did, there's potentially ways, which I won't get into, of rolling it back in. Although it's possible, you may not want to, depending where your income is at, which we'll talk about in a few minutes. So there are some opportunities there as well. And also, just as another side note, this may be an opportunity to do some Roth conversions where basically the market's down. Hopefully it's going to go back up. That's what Ben keeps telling me. So if it's a good opportunity now to to do the conversion while it's down. A couple of small things, and I didn't focus on this, but I'll just mention it. They gave everybody $300. Am I there?
Yeah, you're back.
All right, good. All right, and they also, if you feel charitable, they used to be you're limited to 60% of your adjusted gross income. Now they just said, if you give away if you give away whatever amount of money, there's no limit to your adjusted gross income. So it's encouraging you to give away and be charitable. All right. The other, and this is a big area, and it requires everybody to pay attention to it because you have a certain time frame, and that is back in 2017 when they passed the last big tax bill, the Tax Cut and Jobs Act. You know, they gave you a lot of deductions, depreciation, everything else. But then they said, we're not going to allow you in the past to carry, if you had a loss in the current year, you can carry it back and get money back from prior year. But because we're giving you these deductions, we're going to take away the ability to carry it back. And that was a big change, particularly for people in real estate. Or if you just had a bad year in business or you bought a lot of equipment, you created a loss, you'd carry it back. Well, they did away with that. And they also said, even in the current year, you were limited for the use of NOLs to 80% of your income. So you're going to pay some tax. Well, they did that back, actually beginning of 2018. Now they came along and said, we're still going to allow you all those deductions like before. Now she improved it, which I'll get into in a second. But now you can actually carry it back. And you can actually carry it back 5 years. Going back when I first started in this business too many years ago, used to be you can go back 5, then they changed to 3, then went back to 5, then they went to 2. And it's been at 2 for the last, 15 years. Now they said you can go back 5 years. So for 19, if you have a loss in 19, you can go back to 14. And if you don't use it up in 14, you go to 15, et cetera. So it's a good opportunity if you had a loss in 19 to carry it back. More importantly, they made this law, which is good for me, retroactive to 18. So now you have to go back and amend returns for 18. And where before you had that loss potentially carried over to 19 because you couldn't go back. Well, now you can go back and take that 18 loss and carry it back to 13, right? But you have to do that, I believe, by June 30th. So otherwise it gets carried forward. So it's an opportunity to look, which we are doing, by the way. We're going, taking a listing of everybody that had a loss last year, or a carryover from a prior year that got carried forward into 18 that you couldn't use because there was no carrybacks. Now we're looking at that and saying, hey, we can go back to 13, 14, and 15 or whatever and get back cash. And there's actually like a fax line that the IRS set up, if you can believe it, because nobody's in the office, where you can fax these carrybacks in. So hopefully they process them pretty quick. So they're trying to create liquidity. They're giving you the opportunity to take advantage of these losses. And again, they did away with this limitation of you can only offset 80%. The idea was you had a loss, you shouldn't be able to shelter, all your dividends and interest and capital gains. So they wanted you to pay some tax. Well, now you can shelter everything. That is a big change. And we're now just going through that process of trying to identify those people that have those NOLs, and the dollars can be substantial, particularly, like if you're in real estate or you just started a business and, you bought a restaurant or something and you had huge amounts of build out, there's opportunities there. The other one, which didn't get a lot of press back in the Tax Cut and Jobs Act, but what they also said, if you had big losses from either real estate or business or whatever, that the most you can deduct in any 1 year was $500,000 if you're married, $250,000 for single, and you couldn't offset your interest, your dividends. That was it, or your W-2. It was $500,000. Anything in excess of that got carried forward. So we have a lot of clients that ended up paying tax last year because they were limited because of this $500,000. Well, now, both for 18 and 19, you can go back and actually redo 18's return as if there's no limit. And that creates an NOL, you can go back. Or it could be that you decide if you didn't pay tax in 13, in 14, you can maybe, from a strategy standpoint, to have that, operating loss happen in 19, and then you go back to 14. There's all these planning opportunities, but the long and short is its availability to go back and recoup some taxes that you paid in those earlier years. One of the other big limitation change they made is when they had the tax law change in 17, that, they made a drafting error in the bill. And it was an error that everybody back in 17 acknowledged. The Senate, the House, the President, the IRS, the Treasury, everybody acknowledged it was a mistake. And that was when you go out and you were a tenant and you did your own build out for your space, or you're a landlord and you built out space for a tenant, or you're a restaurant, you did build out for that. Prior to 17, you were able to take that over 15 years, depreciate it, and to some extent, in some cases, depreciate 50% of it up front in what we call a bonus depreciation. What they did is they finally, 2 years later, even though everybody for 2 years acknowledged a mistake, they corrected it, retroactive to 18. So for a lot of returns that we did, a lot of our partnership returns, particularly in the real estate or for some businesses that started up, we are limited in how much of that depreciation we could take. Well, now we can go back, effectively potentially write off that improvement, because once it becomes 15 years, it's eligible for what we call bonus depreciation, which effectively means you can expense it in year one. So there's opportunities, which we're looking at now, to go back, amend 18, take the bonus depreciation, create a net operating loss, either wipe out income for 18 if you pay tax, or create a loss and go back to 13 or 14 or whatever. So there's good opportunities there to try to recoup some money and get some liquidity. And you have decisions to make, because in some cases you may not want to go back if you weren't if you weren't making that much in those years. You may want to go forward and forego carry back, and there are ways of doing that. So you have to look at that and decide what's the best way to maximize your dollars. A couple of other changes from a business perspective. They eased up some of the rules. If you have a leveraged business, there are limitations, the amount of interest you can deduct. Again, that's one of the deductions. When they lowered the corporate rate to 21% back in 17, they took away some of these interest deductions for these highly leveraged companies, even small companies. A lot of our clients were limited. Well, now they upped that limitation from 30% of your income effectively to 50%. So they're trying to find ways to give back what they took away 2 years ago to lessen your taxes. So it's all these opportunities. It's a good chance to look back and see if there's opportunities to get some money back from the prior years. And then, there's other things to talk about in 2020, just because of the economic situation we're in, and some planning, both from an investment perspective, as well as from business perspective, in sort of trying to plan out your income and your, what tax bracket you're in and moves you can do in 2020. Those are the major changes. Jim, Ben, you have any questions that you think?
Yeah, no, absolutely. I'm going to fire off a few questions, Rick, that you mentioned, just to be able to elaborate a little bit on them. Is you mentioned RMDs and not being required to take them. Does that also go into effect for inherited IRAs?
Yes, I would assume that would go in. I believe it does. It does.
So, and January tax law pushed it out to age 72 for
That's
people.
right, under the Secure Act. That's right.
So people that were required in the past to take them now don't have to until they're age 72.
Yes.
Okay.
But having said that, Jim, one thing to think of is, you don't have to take it, because obviously you may want to leave the money invested, but you have to balance that to some extent in what your income is going to be this year if it's way down, because it may make sense
to take it
out,
right.
Especially if you're on furlough or whatever. So there's no easy answer. I think somebody, or I think Ben, you said this, it's all based on your individualized tax plan. And I think that's where there is no one answer fits all.
Yeah, and this might be along the same lines as people that are looking at Roth conversions or considering Roth conversions. Can you just give us a situation where it might be ideal? Is it someone who's furloughed or unemployment, or is it just because the accounts might be down a little bit? What's the best situation when
I
people
think it's a
consider it?
combination of both. I mean, I think obviously a good time is when the market is down, because
Right.
the amount that's taxable is going to be reduced. And then, hopefully when it bounces up a year from now, back where it was, that's what I've been told, then, you obviously get it tax-free effectively if you do the conversion. And I think also, depending on the situation, the amount taxable is going to be less because the market is down, but also your bracket may be down. Your bracket may be the lower bracket, not in the top one. So that's something that also may factor it in.
Yeah. And this question, I know you won't have a definitive answer on, but it's something that we're getting a lot, and obviously has to do a lot with Roth conversions right now, is we're at fairly low tax brackets as we are right now. With all the stimulus, all of the liquidity that's been put into the market, would you expect taxes to go up at some point in the future?
I think the answer is, I would say 100% yes, even though I shouldn't speculate on. It has to go up. I'm not sure it's going to be, obviously, depending on what happens with the election, it could go up next year, but it will go up 3, 4, or 5 years from now. And that, in my own opinion, could even be the capital gain rate could go up. That's just
As
my
well.
opinion. That's what I've seen over the last number of years.
Yeah, and that goes into those conversations about now is even potentially even a better time for the Roth conversions, or even potentially still taking your RMDs just at lower tax brackets with the
Right.
potential for them to be going up at that point.
Yeah.
Perfect. Any other planning opportunities in this economic environment that we're dealing with right now that you can think of?
I think it's just in general, particularly if you have a business, I think in just trying to project out where your income is going to be. I mean, I have a lot of clients that are effectively shut down, that, we're making, substantial amounts of dollars that are shut down now. We don't know when they're going to open up. And when they open up, hopefully you're just breaking even. You don't know if you're going to make any money. So I think there may be some planning opportunities over the next few months that you have to constantly look at where you're going to be. I think that would factor in to some extent on the investment side. Maybe you want to take some gains in a year that you don't have much income. So I think there's just a big planning opportunity over the next few months. I don't think there's anything right now per se that you would do other than look at like the NOL situation I talked about as you get your taxes done. But I think over the next few months, depending how things pan out, when you get open, what your income is going to be, or if you're out of a job where you get your job back, I think there's, you have to look at that and factor in all of those things we talked about, as maybe taking some money out of your retirement, account. If you don't have much income this year, hopefully that's not the case, but if you don't, then maybe an opportunity to take some money out, pay some tax on it, albeit at low rates, and maybe reinvest it.
Yeah. No, I think the one thing that I have heard from clients, both in and the best thing we can do is talk about it. The best thing we can do is communicate with the planners within the firm, obviously tax professionals like yourself, and just get a clear understanding and putting the plan together so that there's a process behind what we're doing.
One thing I would say is I agree with you. There's about the misinformation or so much information.
So much.
I know from our end on like this payroll protection program loan, you can go on the internet and find out so many different, articles on it, and some by some pretty reputable law firms or some accounting firms, probably not reputable, but good accounting firms. Seriously, that are just, interpretations of it that have been clarified in a lot of cases that when the bill was first passed, and that's going to happen again now that the new bill is going to be passed, but when the bill was passed, a lot of people put articles out and their own interpretation. The Treasury came out with guidance. There's still a lot of guidance needed, but before you make any decision, you really got to talk to people and make sure you understand fully what the latest interpretation is. And there may not be. It may be that you have to make your best judgment. It's best move right now, not knowing any final, like in the tax rates. We don't know if tax rates are going up, but you have to sort of make your best educated guess and plan accordingly.
No, I agree. And I appreciate the time, Rick. I'm looking forward to getting back out on the golf course for sure once we get back to it. But we're coming up on the hour. Ben, anything else to add?
No, thank you very much, Rick. Appreciate it. A lot of great information there, and it's great to get information right from reputable source and help folks with their planning.
Right. So that wraps up the session. We look forward to the ones coming in the coming weeks. But again, we will be sending out an email. If you have further questions, how it pertains to you personally, feel free to email us. You'll get a link to our schedule again following this call, and we look forward to speaking with each of you more. Thank you.
Thank you.